Hello, friends. In this session, we are going to discuss a very important topic that can shape your financial future. And the topic is the financial mistakes that people commonly make in their 20s. And I'll also discuss how can you avoid them. See, your 20s are the most crucial period when it comes to, the habits are formed, especially with respect to the finance and the decisions that you take in your 20s. Okay, so that set, the stage for your financial future. So understanding where the pitfalls lie, and it can actually make a significant difference between struggling later or thriving. So let's start this discussion. So we'll discuss these mistakes one by one so you can navigate your financial path with confidence. And once we start discussing one by one, you will also understand what the mistakes that you're currently doing. So let me share the screen, and I have a PPT. So I hope you can see the screen. So let's get started. Right. Okay. So guys, the first and the most important one, I always discuss about this. It's that you are not keeping track of the money. So there's a most fundamental mistake, not tracking where your money goes. It's astonishing how many people don't know the details of their expenses. And sure, it's one thing is sure that you might have a general idea, but do you know precisely how much go towards rent, utilities, groceries, travel, dining out, or subscriptions? Most of you don't know and are not aware of it, right? So, what is the solution? Solution is basically start tracking every expense. Use an expense tracking app. There are a lot of options available, or use an Excel sheet, or even a simple notebook, whatever suit you the best. There are apps which will automatically track your expenses. At least use that also if you are so lazy. And the point is to know exactly where each rupee is going. So when I say track everything, I mean even the smallest of the purchases also. So by recording every little expenditure, you begin to see the bigger picture of your spending habits. Why it is important? Because if you don't know where your money is actually going, you can't manage it. So, and if you can't manage it, certainly you cannot control it, or you cannot make it work for you. What is our ultimate objective? The money should work for you instead of you working for money. So that's why this is very important. Now let's move on to the next point, that is failing to budget, right? Okay, see now, even if you know where your money is going, not having a budget is a major misstep. So you now know where money is going, but you don't have proper budget. So without a budget, your money can slip through your fingers, and you won't even realize it until it's too late. So a simple solution to budgeting is 50-30-20 rule. Now, what does this mean? Allocate 50% of your income for needs. Needs means rent, food, essential utilities. You can spend for this. That's the 50% rule. Okay, 50%. And set aside 30% for wants. So needs and wants are different. Needs means these are essentials. You cannot, you need to pay rent. You need to have food, essential utilities. Wants means like hobbies, outings, entertainments, dining out, and all those things. So 50 for the needs, necessities, and 30 for the wants to give you some luxury, some good feel in your life, and 20% for savings and investment. But don't wait for the month end to do that 20% investment. That 20% should be deducted first and invested, and make sure, you know, rest of the amount only you're going to spend for needs and wants. Okay, so this budgeting strategy basically ensure that you are enjoying life at the same time, having good savings for the future also. So guys, remember, without a budget, financial chaos are inevitable. So you need to have a clear budget. Let's move on to the next slide. Excessive borrowing. See guys, in this digital age, getting credit is easier than ever. So this is both a blessing and a curse also. The problem arises when people borrow excessively because it's so rapidly and so readily available. So you just ask your friend who's sitting in America or US or UK, somewhere else, in seconds he can send to you. That was not the case before, right? So see, think about the personal loans and credit lines. So they used to require extensive paperwork before, but that's not the case now. If you want, you'll get immediately. And earlier, if you want to get, you need a lot of hurdles. You need to give the salary slips, years of ITRs, and more. Now you can get a loan with just a few taps on your phone. There are, again, private companies which will put you in a big trap. They come and offer the loans so easily and cheaply. Again, the question is, do you know the interest rate in that cases also? So sometimes they will tell you that interest rate is, let's say, 10%. So when you look at bank, it is 14%, 15%. So here they may say that 3%. So they are saying 3% per month. In bank, when you say 14% or 12%, it is yearly. 12% means monthly 1%. So when you're borrowing from these kind of apps, it is 3% per month, which is three times that of the bank. So that is again a big trap. Okay, so the credit comes at 30-40%, and if you default, the consequences again can be huge. So these loans basically you know comes at a very high cost, and these loan providers will contact your family. I mean, you might have heard the news. They keep on sending your messages, right? Your family, your colleagues, and even your employer to get their money back. They'll go to any extent, and that kind of consequences will be there. And I've seen many cases that the people are committing suicide. And imagine the stress and the reputation damage. Okay, so my simple advice is borrow only if it is necessary, as little as possible. Ideally, limit it to just two types of loans: education loan, home loan. Okay, so any other type of loan, think 100 times before you taking it. It's not actually required. Maybe if you feel comfortable after some time when you have a good job and everything, a car loan. Okay, so these are the three loans which you actually need. Now, coming to delaying investment, I always tell that income minus investment or saving is going to be your expenditure. So you need to make it a priority. So there's a big one, there's a huge one. Many people in their 20s think I'll start investing when I earn more. So it's not the case. You need to start early, or they will think that I'll start when my salary is stable. And this delay can be costly. You can start with a very small amount also, that build the habit. That's very important. In your 20s, you need to do that. So starting early with even small amounts give you the advantage of compounding. For example, starting with 500 rupee today can have a significant impact over the years. So the earlier you start, the less you need to invest each month to reach the same financial goal compared to starting later. Okay, so don't wait for the perfect time. It doesn't exist. I told you many times, yesterday was the best time. You didn't do that. So today is the second best time which is available to you, not tomorrow. So the best time to start investing is now. Now the best time available for you is today. Now. So start investing at least small today. Next is again a big mistake, that ignoring insurance. You may think that I need to pay the premium and that's waste of money. There is no chance that I get any health issue, or there is no point in term insurance. No, that's not the case. The earlier you take term insurance, premium is very less. What if some unforeseen situation comes? Your family is safe, so term insurance is a must, and you're getting at a cheap premium as you're taking it early. And health also the same thing. You are one medical emergency away from poverty. So if you have a medical insurance, health insurance, that is also taken care. So these two are must. Insurance is often overlooked, especially by young adults. In your 20s, you won't understand the importance of that. But if you are the primary breadwinner or have dependents, this can be a major risk. What if something happens to you, health-wise also, or otherwise also? A term insurance will definitely, be a big support at this point of time. So insurance is not just a tax saving tool. There is a lot of benefits also. You can save tax, right? And it's a safeguard for your family and your financial responsibilities. And purchasing life insurance in your 20s is smart, because you lock in a lower premium for life. As you age, premiums go up. So you're getting a better option now. And guys, let's not forget about health insurance. Health insurance is again very important. It's the most important one because nowadays the way the medical bills are, or the way the prices are going up, you will not be able to manage if there is something happens. Okay, so make sure you are covered, your family is covered, your parents are covered. Otherwise, it's going to be a huge expense for you. And treat insurance as an investment also. See, one of the most common financial mistake in viewing is actually viewing insurance as an investment. So there are products like ULIPs or guaranteed return plans may sound appealing, but they typically provide poor returns. But again, insurance is a safe investment option. But again, when it comes to the return options, it's not that great compared to mutual funds. So instead, what you can do is opt for a term insurance for coverage and keep your investments separate. Invest in mutual funds, ELSs, or NPS for growth. Term insurance is required, but again, if you look for, there are certain insurance which provide you means life coverage at the same time investment option if you are comfortable, because insurance, you will get the insurance, you will get that investment benefit, you'll get the tax saving, and all those benefits are there. And return, if you compare with other options, it will be less. If you understand that, and then still if you can do that, safety is more. Okay, so guaranteed return also you can do that. So guys, remember always, insurance is for protection and investments are for growth. So mixing the two often lead to poor results for you. So understand both, how it work and everything, and then go for it. Always people ignore the emergency fund. They spend everything as and when you get that. See, I can't stress enough how essential an emergency fund is, and that's what many people are actually overlooking. They ignore that. They spend everything, and any emergency come, they start immediately calling friends and start borrowing. It's very difficult, and it's a very bad feeling also at that point of time. So what my point is, any unexpected event, it could be a job loss, it could be a medical expense, or any emergency for your family member, any urgent need, it can disrupt your financial stability. So what is suggested is, aim to have at least 6 months worth of essential expenses as your emergency fund, and it should be set aside without touching. Okay, so this is not for growth. This is something which we are not going to invest or anything. We are not worried about that this money is not growing and other things. It's for security of you and your family. Must do. Okay, so keep this money in a safe, accessible place like savings account or FD. It's not about earning interest, but it's about having a safety net. Okay, if some emergency happens, this is there for you. Now, the next one, this is again very important one, relying solely on employer provided health insurance. See, many young professionals believe their company's health insurance is sufficient, but the problem is it often only covers you and not your family. I want you to have an insurance where you and your family are covered, because you are the breadwinner and you need to take responsibility of your family also. So if any emergency happen to your family, it's definitely going to affect your financial health as well. So that need to be taken into consideration. So employer insurance ends when your job does. So that's again, there's a serious gap if you switch jobs or become unemployed also. Okay, and pre-existing conditions can make it difficult to get new insurance also. So we need a continuous policy. Okay, so and waiting periods again, if you switch job or if you get unemployed, if you want to take new one, so all these are big issue. And all these are again, you switch job, then again there may be waiting period. You lost the job, you are again now going to take your own insurance, again there is a waiting period. So the gap is there. Always have a personal health insurance plan in addition to whatever corporate coverage is there. You need to have your personal, which is going to cover your family also. Now, the next mistake is actually taking loans to invest. Investing with borrowed money is another pitfall that many fall into. Okay, so especially when trying to leverage returns in the stock market. Normal case, you won't get return as much as the interest that you need to pay, but you are attracted with stock market, eventually what will happen is there is going to be a big loss if you are trading or investing with the borrowed money, or you may not get the return anyway. So interest on loans is fixed, but returns on investments are variable. Irrespective of what you're getting as return, or you're losing or you're making profit, it is variable, depends on market condition, but this interest at which you have borrowed is fixed and you have to pay. So if your investment doesn't yield the expected return, you're left out, with a debt actually, and you're left, you need to keep on repaying the loan at a higher rate than what you have earned. So effectively, you are losing here. And this is risky, especially if you are using high interest loans, like you are taking personal loans or credit card loans. Don't do it. I've seen many of my mentees in trading, they used to come with personal loans, which comes at a higher interest rate, and that keep in debt burden. And they are trying to learn trading by using personal loan. So in the initial stage, the struggles that a trader will go through, that's not acceptable, should not be done. Okay, so never ever invest in stock market with the borrowed money. Remember, borrowing comes with the fixed interest that you need to repay at any cost at any point of time, but investment and all these are subject to market conditions, and there are variations. Again, many will fall into this get rich quick schemes. See, there are a lot of schemes that promise to double your money overnight. It can be tempting, but they are dangerous. Okay. See, if something sounds too good to be true, you know, the chances are very less. There is no easy money. There is no easy money in life, and these schemes often end up in loss only. There is no easy money. There is no easy way you can earn money. Okay, that's why you always tell hard earned money. There is no easy money. Remember that always. And no one is going to do it for you. So the best way to build wealth is through slow, consistent growth. It may not be glamorous, but it's effective. It's not painful. Now, coming to the next one, over diversification. Okay, this is another mistake, which is going overboard with diversification. Uh, People often think that having many mutual funds is the key to have a safety and growth. But again, that's not the case. Too many funds mean overlapping investments, right? So many mutual funds, the investments in their stocks will be overlapping. So that is leading to diluted returns and unnecessary management fees here and there and everywhere. You need to pay the fees for management also. And investments are overlapping. Both of them might be buying Reliance, both of them might be buying Tata Steel. So why you invest in one only? Or if you want to do that, check where it is overlapping. Avoid if it is overlapping. Okay, now stick to three main types of funds: one large cap, one mid cap, and one flexi cap, or one small cap. So if you focus on this and if you try to align with this and take a combinations of this, then there is no problem, and adjust according to your risk appetite. So this gives you sufficient exposure without complicating your portfolio. Okay, now coming to over reliance on family or for financial decisions. See, this is again trap at the 20s. Relying too much on your family for financial guidance can limit your growth, especially if their knowledge is outdated or limited. Your parents' approach, which is focusing on FD and avoiding stock market, or afraid of stock market, may not be suitable for today's economic environment. Tomorrow it may change again. Okay, but stock market will be there every time anyway, as long as India is there. Now take responsibility for your financial journey. Learn, educate yourself, and make decisions that align with your financial goals. Okay, always keep it in mind. Buying a house too early. See, the pressure to buy a house in your 20s can come from your parents. They want you to get settled, marry, have a house, have a kid, settle. That's what they believe. That's not the case. It is actually the pressure which is coming from friends, because your friends might have bought the house, or society. Society is also telling you to buy a house because they will acknowledge your success only if they see that you are having your own house, right? But purchasing property too early can tie you down the interest and the EMIs that you need to pay. right? So early in your career, flexibility is very crucial. You may have to shift. That renting offers more mobility. That possibility of movement and everything is there. So that's flexible. And often, when you buy the house, it costs significantly. Okay, in terms of EMIs and other things, the interest that you need to pay for a long period of time. But once you get settled, you don't know at what age and where you are going to get settled, in which company you're going to get settled, in what place you're going to get settled. So early in 20s, don't try to buy the house. So if you have too much of money and only for investment purpose, if you're doing it, do it. Because you don't know whether you will be staying there. If not, if you're moving, you need to take another house for rent in that place, right? So the renting always offers that mobility. Remember that. Till the time you get completely settled, it's better to avoid. Your parents have a home, well and good, at your native place, right? And then keep on renting wherever you go. That offers that flexibility and mobility. That EMI burden is also not there. Okay. So what you can do is during this time, you can save for a substantial amount for down payment. The EMIs that you are supposed to pay, otherwise, you keep invested, you get an average return, it will compound, and you can make a good amount for your down payment in future. And once you're ready to settle in a place, then you can use this money to buy the house. Again, high risk short term investments. That's another one. See, investing in high risk assets for the short term can be dangerous. For example, small cap stocks, it can fluctuate wildly, but you may got some amount and you invested by looking at the returns, but it may be dangerous. So investing in them only for a couple of years can result in substantial loss. Sometimes it may grow faster, but you don't know. It may take time. It may give a dip. It can fluctuate. It can go wild. Okay, but definitely there is a growth, prosperous, opportunity, but you don't know at what time. So waiting period is there. You need to give time. The longer you invest, the more you reduce the inherent risk in that. So if you plan to hold investment for 5 to 10 years, your risk decrease significantly. Otherwise, risk is always there. Okay. Now coming to this underestimating the expenses, the last one. It's easy to miscalculate how much you will need to have for day-to-day life and for your future goals. So what you need to do is uh, the expense often go beyond rent and food. It's not about the rent that you pay or the food. We have already discussed about this in the expense tracker. So consider long-term goals also. That is also involved, right? Your education, higher education, buying a house, saving for a wedding, buying a car, and future children's education. All these can be taken into consideration. So don't underestimate the impact of lifestyle changes and inflation on your expenses. This also again need to be considered. So plan for these with foresight. I can tell you in your 20s, if you can have some idea, knowledge about all these, you will get success. We realize that in the mid of 30s. Okay, so then it is going to be difficult. There is no going back. That's why advising you, because most of you if you have good financial background or family background, it's good, but most of you who are listening to me, that's not the case. The parents may not be able to advise you on these matters, right? Now lastly, perhaps the most important one, don't ever lose hope. If that's the case, I wouldn't sit here. The tragedies that I have undergone at different times, and when it came to my last, that's when I got detected with cancer, still survived. Okay, so well, this is just financial. So financial difficulties can feel overwhelming, but they are not insurmountable. So guys, these are what I wanted to give you. These are the common financial mistake people make in their 20s. Now, being aware and taking steps to avoid them, you are already on the path to financial success. So your 20s are the best time to form healthy financial habits. So set your goals, build a secure future. Now, remember, the decisions that you make today will shape your life for years to come. So, always keep that in mind and be disciplined, keep invested, stay consistent. That's it for today. Thank you so much for attending the session. See you in the next video. Any doubts, any questions, any support you need, you can always get in touch with me.